Hey everyone, welcome to the Mogul webinar live. Again, this is the last Tuesday of every month where we host about an hour to go through all things Mogul, new property updates, new platform updates, and all the above. With me always is my co-founder, Joey. If Joey, you want to say hi to everyone real quick before
What's
we
up,
jump.
everybody? Good to be back.
Well, I think we have, obviously, I know we started just on time, and at GS, you always had to start about 5 minutes later for everyone to actually be there. So I'm sure we can give it like 2 seconds before we jump full time into this, because there are obviously some very exciting updates that we have on the horizon that we would want to go over with all the people on board. And so we see that number keep climbing on the registrants. And as a reminder, as always, the format of it will be we'll go over some properties, some platform updates, go into any new material updates that can shape how you will be investing in real estate on platform. And then from there, we'll open up to any and all questions. By all means, start to shoot everything in the chat. Or if you don't want everyone to see your questions and just want us to see your questions, shoot a question in the questions tab. And so with that, I think we can get started. But as a reminder, just keep adding questions in there. But I think we can get started, right, Joey?
Let's do it.
Perfect, perfect. Well, obviously, the reminder to us, we are the fractional investing platform started by two GS alumni, myself and Joey. We're both at Goldman, where we invested in real estate up and down the cap stack, both debt and equity. And Joey had a specialty. I joke that he's the residential wunderkind, so to speak, having grown Goldman's single family rental platform from 0 to 1 billion in under 12 months with 3 to 4 individuals. And so that's background on us. We wanted to provide a way to invest in the types and quality of real estate assets that we had invested in during our time at GS. And that's when Mogul came about. And so, Joey, I don't know if you want to give a brief overview of yourself before we dive fully into it.
Yeah, I mean, as Alex said, specialized in the residential sector kind of while we were at Goldman Sachs, focusing on multifamily and single family rental products. So think all kinds of business plans, all kinds of different big operators in the space we were working with, all kinds of different structures when it came to equity and debt investing for the capital stacks. And it originally inspired us to kind of bring the product that we bring on the Mogul platform to light. And so that's how we started kind of in the single family rental space, realizing a lot of the efficiencies that are driven by kind of operating, with the single property LLCs and all those benefits that we can pass along to our investors pro rata, including those potential tax benefits associated with the cash flow and the appreciation. That's the product we're focused on today. We're expanding into some multifamily products coming through the pipe. We're expanding into some really cool residential product and obviously working with midterm rentals, short-term rentals, long-term rentals, you name it. So really exciting stuff.
Yeah, very exciting. We actually partnered directly up with the Pad Split team, was at their launch event in Boston. We're going to continue doing a number of these different launch events alongside them as we continue to be great partners with them to invest in the Pad Split offerings. And so with that, I know we kind of gave a high level overview last time and gave the opportunity for people to partake in the Mogul Clubs platform. But for those of you who aren't familiar, we're going to just jump in real quick, give a complete high level overview to the Mogul Clubs angle. This is different than obviously within the real estate investment side of it. It's kind of a way for you to invest alongside community. And so with that, I can quickly share my screen and then we'll go into some surprise updates later on. Obviously, I warrant the surprise or give exciting like forewarning about it before we jump in. So here's a quick overview. Can you see my screen?
Yes, sir.
They can't respond, so you've got to respond. So this is the Mogul Clubs component. So as you might have seen, it has become unhidden for everyone on platform to use. We're doing an exciting announcement later this week with a very surprise Mogul Club with a massive organization that we partnered up with. So this is a way for you all to get involved a little bit before that update. And so that's Thursday this week. We're doing a pretty mass press release around it. But again, just an overview. Really, the idea is invest alongside moguls, invest like a mogul alongside other moguls. So it's a community forum, a way for you all to invest. We obviously have the invite tab. Thomas, if you wanted to send the invite link in the chat, by all means, we can go ahead and do that. We did a surprise VIP sale of the Taylor earlier, I think it was last week, and so people could get in on those. So if you want some early access, this is just one of the many Mogul clubs that we have available. It's been growing out pretty substantially, I would say, over the last little bit. You can see invested dollars, rewards distributed. So that brings me to the rewards distributed. So whenever anyone invests, we decided, listen, let's cut Mogul's margin down a little bit and incentivize everyone to share it out alongside one another. So we offer out the ability for everyone to receive rewards based on how much people are investing. And so $1,000 in, you'll get $20 back distributed to end investors, pro rata to the amount you've invested. Again, it's not investing in the community, it's investing in the properties, and it counts towards the total form invested in. So that's kind of an overview. We have obviously the about section, the community section, the rewards section. So you can go in and play around with that. I know Thomas probably adds it in the group chat. I think he did right off the bat. And so this is just one of the ways that you can engage with everyone else and earn as they're investing, as you're investing, and basically just help grow out Mogul's community and spread the word. Now, outside of this too, we do have a pretty cool excitement where it is, yes, so this is the new help center, the new home to the Mogul.
Real quick, Alex, before you dive into that, we did get a fun question. What is your favorite investing book from Jennifer? Before we dive into the second product launch, thought that'd be a fun one, and you'd appreciate that question as well.
I do appreciate it. I'm trying to see if it's actually on my shelf. Because fun fact, when we moved from Dallas to DC, half my books got stolen in the move. Don't really know why they stole the books. I mean, knowledge is invaluable, but at the same time, I don't think it's on my shelf right now. But A Random Walk Down Wall Street is honestly the best book I could have ever imagined. Before I started at Goldman, I basically took an entire summer and read, I challenged myself to read Atlas Shrugged as well as multiple other books, and Random Walk Down Wall Street was the one that was recommended above everything else. Now, I will say it is one of the driest texts you could imagine, but it explains things in a very comprehensive way. It gives you the data behind why they're explained that way, as well as provokes you or prompts you to ask the questions that are necessary to invest. It explains things like weighted dollar cost averaging, ETFs, what it means to actually become an investor versus just guessing randomly. And kind of, there's another book up on my shelf, Fooled by Randomness. So it avoids the random nature of investing in anything. And so I would say A Random Walk Down Wall Street, can't beat it. It's definitely one of my top. I mean, what's yours, Joey?
Yeah, I mean, you actually recommended two of my top ones, and I'm not going to lie, the first iteration that I did between them about 2 years ago was on SparkNotes, so I'll be honest about that. And then I actually read this one, which was my favorite so far, Rich Dad, Poor Dad, which is obviously by Kiyosaki. Yeah, so great. You recommended that to me, right, Alex?
I did not.
I thought you'd recommended that and Walk Down Wall Street to me when we were talking about public equities about 2.5 years ago and the complexities of how they interact with the private markets. But maybe I'm mistaken. Maybe that incredible recommendation came from someone else. And you know what? I'll give the credit elsewhere. So
yeah, no, I'm not gonna take that away from the person that recommended it to you. I'm looking around because the bookshelf has actually gone. There is a bunch of books on the ground over here too. I got a mix of I started to reread Hitchhiker's Guide to the Galaxy this week for those of you who like just a fun book to read. But yeah, definitely have a tremendous amount of invested. Fooled by Randomness is a great one. Anyway, that's diving way too in depth to what was supposed to be a 5-second question. So I do apologize. Now we're back. All right. So the new help center. So this is Mogul's new help center. So obviously we have FAQs on everything. And so we give pretty comprehensive overviews on the platform. What is Mogul? What are the key features behind Mogul, including the dedicated support, the calculator tool, after you invest, what you can expect there, dashboard and portfolio page. So walking you through exactly what it is that you're looking at when you look at the individual properties themselves, what it means to join and create a club. Now, outside of that too, as you're starting to form these clubs, these Mogul clubs, we thought let's give a little bit more and helpful tools and tips to actually grow out your own club and become a quote unquote chief mogul by creating your own club. And so within the chief mogul, you actually have a chief mogul quote unquote Bible that we're doing. And so you can go in here and learn a little bit more about what it means to actually set up your club and get it going, and then how to boost member engagement, best practices that we've seen as it relates to clubs, suggesting content strategies, all these different things. If you see something that you would like to add to the clubs, I definitely would recommend it. We do have this cool Ask AI component where you can ask based on obviously everything that we have in here. And we also have a great search function, but I just think that this is a cool one. Let's see if, yep. And then there's also a light and dark mode. Not that that's like the most pressing thing, but I just thought that that was kind of cool. But without further ado, I'm done geeking out over the platform updates, but also definitely do ask any other questions that we can answer, not only on this call, but in the new help desk forum. So Joey, I mean, I don't know, I think there was something we had to go through, and I think it could definitely, oh, did you
Boom.
just take over your screen?
Boom. Just took it over just like that.
Oh, wait, give it back real quick.
Oh.
All right, so in here, you just ruined any of the pageants behind it. We have a new VIP launch of the VIP launch of the Ratliff. Oh. So yeah, I can edit it later, but for those of you on the webinar to incentivize people to come back to it. But anyway, boom. I think that hyperlinks. If not, I'll just hyperlink it real quick.
Thomas also dropped the link to it in the chat as well.
Dude, you just destroyed any sort of pageantry I had in this. So I'm just going to stop.
You got to keep things interesting, you know?
Yeah, I'll stop. How the hell did I stop? All right, there we go. Stop sharing. All right, you're up.
All right. So without further ado, as promised, per usual, we have another live property launch with exclusive access to all of you live here on the webinar. This one is the Ratliff, aptly named after another one of the White Lotus family names / characters. This one's super special. So this one we got off market. It's out in kind of West Atlanta here, as you can see on the map. Let me know if you guys can see that. All right. This one, super strong yield. So again, just kind of walking down through, what the business plan is, what the description is here. This one is, what they would call Victorian style home. It converted to 7 bedrooms, 2.5 baths, with a full 2-car garage, full backyard, full deck, fully renovated, completed in 2022. This one has actuals that are in line with the year 1 projected rents, being that the actuals that were paid out from pad split were post fees, mind you, and we are projecting the rents pre-fees to be more conservative on the year 1 underwriting going forward, meaning that we're being overly conservative or more conservative because the fees will obviously come out of the gross rents that they were projecting going forward to be a little bit more scrutinous on those rents. So this, great business plan. And again, the average yield on this one is going to be 14.6 going forward. Average annual return is above a 15%. So tremendously valuable yield there. Typical of what we see on a lot of the more valuable kind of yield plays with the pad split properties. And we are opening this up for investment now. So we just posted the links, as Alex mentioned, in the 400 Club, as well as in the chat. So definitely go check out the property page yourself if you haven't already. Just walking down, $325K purchase price, and we're financing this at 70% LTV with an APR at 6.75%, interest only loan that's qualified with debt service coverage ratio rents. So just as a quick refresher, we take out interest only loans on all of our properties, typically at 65 to 80% LTV. Depending on how the underwriting works out, and we sensitize all of the possibilities between the different loan to values and the different APRs associated with those different loan to values across a table that we then plug in and optimize for each of the underwritings that we do. So, on this one, it's going to be 70% LTV with 6.75% interest only loan, meaning that you're not paying down the principal on that loan. You're taking out 70% loan to value, and that will remain in place until the asset is either recapitalized through a refinance or sold, meaning that a higher distribution of dividends can be paid out through the entire hold and through the business plan. Per usual, we have our sales comps here justifying the basis, really healthy in terms of similar product that's actually a lot of it's older. Pulled this from the CMA with our partners, the comparative market analysis, to show you kind of, what the justification is behind the basis, business plan, and exit is what I like to define as the 3 pillars of our underwriting. You can go through your calculator, type in your investment amount that you want to look at. And then, subsequently you can see exactly what your return will look like through a base bull and bear case scenario strictly from the underwriting. And this is more of the high level overview you see on the property page, whereas you can go to the calculator function we have on the analysis tool per usual, which I'll just give you a quick refresh on to see a lot of the more specifics around, some of the underwritings that we do, as well as play around with the assumptions yourself, so you can go in here, play around with what you think, if you want to be a little bit more conservative on your base case rents, you can go and put that in, see what that does to your underwriting and see what that does to your average yield. So super, super exciting tool. And you can go down and, see exactly the cash flow breaks down through your 10-year hold. You can change the hold as well, change all of your financing assumptions. It's very, very dynamic, this tool. And it's actually the first pass through that I do on all my underwritings now. So, shout out to the team for building such an incredible tool that's replaced all of my heavy Excel work. So let me just go back here to the property page.
Some investment.
Is that right? Let's refresh the page here and see what we have. Nice, very nice. It's ticking up.
Very cool.
Awesome.
I think we're having a question that's coming in here shortly. If you have any other questions about the property specifically, by all means, shoot them in the chat, and we're more than happy to answer. I know I actually get made fun of by my significant other because she overhears me always say, add more questions in the chat, or feel free to send them in the chat and we'll be sure to answer them. But I feel like I have to mention it just in case you do have a question and you're like, how the hell do I submit it? So you can by all means submit it in the chat there. But yeah, I mean, while we're waiting, I think there anyway, I mean, we can dive into anything else, but I'm happy to ask you questions, Joey, on the, could you please share a link to the analysis tab? And then also refresh again, I'm getting pinged about, but could you please share a link to the analysis tab? Yeah. Thomas, you want to shoot that in the chat? Can we shoot that in the chat? I think we can do that live.
Perfect. And I think I was just told to refresh the screen. I think we just did get another investment as well.
Nice.
Yeah.
Wait, refresh one more time.
Refresh again.
Yeah. Woo. There we go. All right. People are coming in. All right. This one is definitely going to sell out pretty quickly. I mean, that average yield is ridiculous, Joey. You outdone yourself again.
I mean, it's just all about the analysis. We make zero decisions based off of subjectivity. It's all based off the data. We back every single assumption we make. And yeah, really quick, just to finish off what I was saying, you could go through, the capitalization here, go through the hold, again, check the dynamic map to, zoom in and around the area, kind of see the points of interest when you zoom in, and then, in your market analysis down here, important docs down here. So yeah, back to you, Alex.
No, I mean, I guess why Douglasville in particular, it seems like it's pretty far outside the Atlanta metropolitan area. What do you see in terms of tenants that are looking to rent at this one versus any of the other ones that we've been listing outside of Atlanta?
Yeah, 100%. I could go on about this for hours, but the West Atlanta right now has really, really good fundamentals in terms of the access to transit, location, kind of insulated from a lot of the, downtown city noise, which is beneficial for tenants looking for that kind of, 1, 3, 6 month stay on that kind of month-to-month renewal lease as they're traveling for work, as they're working, along the industrial corridor, both north and west. And thinking through, how we target different zip codes kind of in and around the markets that we're looking at for pad splits. One of the things that's really, really interesting and important that we do as diligence behind the scenes is that I talk with our property management teams, our operators, to make sure that we are very, very aware about permitting and zoning requirements and kind of a lot of the municipal court battles that go on for, just different housing issues across different markets. It really, really depends. But, Atlanta, obviously one of the founding pieces for the pad split model and very, very beneficial for kind of the midterm rental model. We like to make sure that we target these zip codes where, no known permitting or zoning issues, very, again, insulated to make sure that the home itself is undisturbed and, the tenants have access, plenty of parking, plenty of space to go in and out. And that's, apparent here again with the 2-car garage and space for an additional 4 cars in the driveway, as well as street parking. Not that every tenant has a car as they're commuting, but the optionality has to be there. And, again, the fact that it's fully renovated, just make sure that we're providing the best possible experience for our midterm tenants. And, just huge shout out to the property management teams that we work with in our favored markets to just for the diligence and also the relationship building and kind of tenant management that we have.
Definitely. And one thing too, you mentioned obviously that making sure that we comply with local regulations and making sure that we're zoned appropriately. One thing that's really cool about the Pad Split team, they're obviously very mission driven and very, very mission focused. And so when I got a chance to go out there with their Boston launch event, they did discuss the ability for them to help fight the city and fight the local regulations if for whatever reason they do change, and they've more times than not won, especially given the fact that it's like, listen, we've got a tremendous amount of workforce housing that we're offering out to individuals on a more affordable basis. What are you going to do with those 7,000 plus people that you're going to displace and basically remove from the local economy? And so they've won pretty much every single time that they fought it, and they're very vocal about the fact that they're open to fighting it. So that was something that was very cool that was discussed at the Pad Split launch event in Boston a few weeks back, and we'll continue to do some launch events alongside them. But Joey, any other? I guess one of the other questions is obviously the parking lot space or the parking spaces, but you mentioned that answer to that already. So feel free if anyone has any other questions in there. Thomas, if you want to pipe in any from that you've heard from people that didn't get a chance to make it to the call. If not, no worries. We can go forward and go on to the next property. So with that, I mean, Joey, I don't see any other questions on this property. So by all means, Piper, no, like that. Anyway, just go to the other property.
Yeah, which one would you do next? The Taylor?
I would, yeah, let's go to Taylor. It's about
awesome. Yeah. So yeah, as a reminder, this is one that we launched early last week, kind of to the full Mogul club, if you will. And this one again, as a reminder, is an 8-bed, 3-bath, located out in Houston. So you can go down to the dynamic map, see exactly where it's located. This one is in northeast Houston, right next door to the clear pad that we launched. Actually, I like to call them carbon copies of each other because they were both retrofitted to be pad splits that are operating out in this northeast area with good comps and very, very similar business plans and bases also as well, just given they're the same purchase price and they were part of a 2-pack deal. So going through this one, again, freshly renovated property, we did take out proceeds at 70% LTV with that 6.75% interest only loan. The underwriting on this one is actually very conservative because this one has year one rents that are actually below where the T12 has performed, which is really, really great. And that's, again, even accounting for fees, right? So we had T12 performance where Pad Split was paying us out income on the T12, meaning the 12 months of performance in the past, historically, that are above where the gross rents are year one pre-fees that are then netted out, lowering that gross rent to that effective rent in our year one business plan, still achieving an 18% average yield through the 10-year hold. So, really, really great property, just great fundamentals out here. We are in the process of, going through, again, that standard, purchase and sale agreement milestone that we talked about on the previous webinar, when it comes to your inspection contingency, your appraisal contingency, and ultimately your financing contingency culminating in the close. So if you go, again, down, you can just go through your calculator, type in your investment size, see what you want to do, play around with the base, full, and bear case assumptions. And then if you want to go to that analysis tab, you can see all of our properties that are actually on the platform. And then also if you want to underwrite any of your own, you can add those in as well. But I'll pause there. If any other questions are coming up, happy to answer some of those. Don't need to take you through the exact property page again, given, we're familiar with this.
I was told to refresh the Taylor.
Refresh this page.
Yeah, this page, I believe. Sweet. Another like 6K in the door, which is cool. Awesome. Well, on this one, one of the questions that we get is, how do pad splits generate such high yields? I mean, obviously, I know that's pretty transparent, but that's just one of the questions that we get. It's like, how the hell does something, especially in real estate and single family rental, generate an average yield of 18.3 over the lifetime of the hold?
Yeah, I mean, I can walk you through it. So just thinking through the day one and then how it trends, how it grows throughout your hold. Day one, we're justifying rents that, again, are based off of historical performance, especially with pad splits. One, because of, again, the innovation that's going on in the market, lending requirements, very, very strict guidelines on how these are operating as assets. We want to make sure that the historical performance is there. It also helps to mitigate against any, permitting zoning risk, because if the property's been operating for 12 plus months, it's obviously a good signaling indicator that it's going to continue to operate healthy. In addition to justifying the year one rent. So, once you have your year one rents in the underwriting, right, we then walk that through the 10-year hold. You can justify those year one rents by looking at comps, looking at the T12 performance, getting that appraisal for both short-term and long-term rents. And then in addition to that, your top line revenue growth is going to be anywhere from 2 to 4% annually. And that's just assuming kind of inflationary, right? We increase the rents, again, 2 to 3% per year minimum. And that applies to each room as it is on the room, lease by room kind of structure with each of these pad splits. That top line revenue is growing at a margin that's faster than what your expense grows typically, especially when it comes to the pad splits. The expense growth margin, when it comes to your insurance, your property taxes, especially in places like Atlanta and Houston, those are ticking up, typically 1% or less per year, 1 to 2% max. And so when you're thinking about your expenses growing at 1 to 2%, and your rent's going at 2 to 3%, you're actually experiencing, net growth on your income through the 10-year hold. And so even though your basis stays the same, because again, we capitalize several forms of contingencies to make sure that we're not making capital calls from our investors, meaning that you don't have to put in more equity, diluting what that yield is going to be through the hold. So as that net income grows through the hold, your basis stays the same, your net income is going up, your basis is staying linear. And so your yield is increasing through the hold, right? And so even though this one, has a year one yield, cash on cash yield of about 13%, 13.5%, you're looking at an average yield through the hold of 10 years of 18.3%, because again, that's growing, given that your net income is growing through the hold while your basis is the same. So I hope that makes sense.
Perfect. Yeah, that definitely helps answer that. One of the comments we got is from Jennifer. This is like watching the market with an angel emoji. Yeah, angel emoji. So thank you, Jennifer. We appreciate that. And definitely, if there are any things that we can help to answer, and also any things that you want us to go over, even if related loosely to the markets, we're more than happy to answer them here. Joseph just asked, can you please talk a little bit about the decision not to share appraisals once they're available? Properties I decide against investing in on Mogul are almost always due to a lack of sales comps. I think it would be helpful to see what I'm missing. I'm curious if they're leaning more heavily on the income approach in the investments, or if there's something else I'm seeing wrong. So Joey, do you want to take that?
Yeah, 100%. I'll break this up into two parts. One, why we're not showing the appraisals unless you're invested in the property. And then also two, the sales approach versus the income approach. I'll talk about that as well. The first point, it actually came up trial by fire, because we were posting the appraisals that was available to anyone that signed up for the platform, and this was actually during active negotiation periods. So when a property is live, anyone can go in there, see the appraisal. That includes counterparties, right? So you're talking about lenders in terms of other lenders that we're working with that haven't ordered appraisals. You're talking about sellers, which are going in there and seeing the appraisal before we've even had a chance to retrade. If, say, an appraisal were to come in below where the purchase price was, right, triggering that appraisal contingency within our purchase and sale agreements. You're talking about sellers agents that are signing up, potentially for our platform and going in and accessing sensitive documents. Again, just giving them that edge kind of to negotiate against ourselves, as we're launching these properties live. And so, one of the many benefits, obviously, of real estate, and especially private real estate, is that you have a lot of control over your basis, business plan, and exit, the 3 value drivers of real estate. And so we just need to protect our investors by effectively making sure that that information isn't made public, sharing appraisal data, even with anyone but the buyer from a lender perspective is a very, very big no-no in the market, and definitely against kind of best practices, even as it comes with kind of brokers and broker licenses as well, just making sure that they're not sharing that sensitive data anywhere outside of with the contracted client. So we want to, respect the same, make sure that we're not oversharing and hurting ourselves in the process, hurting our investors in the process. So that is the thought process behind that. Other than that, the appraisals will be uploaded to people that are invested in the property, so that way you will have access to that. And additionally, we will not move forward with the property if it hasn't past the appraisal contingency as that second milestone of that purchase and sale agreement. We're thinking about adding an indicator on the property pages to, say whether the property just appraised or not, which we'll work on in the future. But just so everyone's aware, if that contingency isn't passed, the purchase and sale agreement is up for cancellation or retrade, which, will happen. And we wouldn't obviously just go forward with purchasing a property when that appraisal contingency is triggered. And on the back half of it, just quickly touching on the sales comp approach versus the income approach. So the purpose of the appraisal, first and foremost, right, is for the lender to kind of confirm the value, to make sure they're not lending against the value that's over what the property is worth on paper. And so not only does that protect us as the buyer to make sure that we're actually getting the value of what we're purchasing for the price that we're purchasing at, but it also protects the lender because it allows them to see, that 70 to 75% LTV is 70 to 75% of the total purchase price. And they're not going to want to lend at a higher margin on an inflated value, because that's how 2008 happens, effectively, in a nutshell. And so, when you're thinking about the sales comp approach versus the income approach, yes, I don't know why Alex is smirking right now, but yes, on the appraisals, you do see sales comp approach, you see income approach, you see cost approach, right? Cost approach being replacement cost, the three, value, backing into value for real estate, valuation techniques, sorry. And so with single family rentals and anything kind of, 1 to 4 unit, you're always going to see the lender using the sales comp approach to confirm value, even though the income approach is there for the DSCR qualification, which again is that debt service coverage ratio, making sure the revenue coming in from the rent business plan, whatever it is covering that debt service, so that, that APR that the lender is giving you in exchange for the proceeds that you're taking out. The income approach is there in the appraisal to cover that and make sure that DSCR is healthy. And usually we've covered 1.2 plus for every single property we brought on the platform, which is tremendous. And we get commended for that all the time. But the sales approach is there to actually confirm the value. And that's the one that's taken into account. The income approach is not taken into account when we're thinking about the actual value of the property. So just a little bit of insight there.
So I was smirking at the fact that you just like casually dropped causation of the 2008 crisis, and you're like, yep, and ipso facto, 2008.
I mean, in a nutshell, yeah. I mean, that's an oversimplification, but that's kind
of it's like when last week when Eitan messaged you when we were having a very serious discussion, and you just started smirking, and
that was the best.
Our head of engineering or our CTO messaging. Sometimes I feel like the engineer, the comp sci guy from Mission Impossible, and I'm just the guy behind the computer. But anyway, I digress. Shout out to Eitan there. All right, so hopefully that answered your question, Joseph. Let us know. If not, I'm more than happy to dive into anything in particular. Jennifer Loren said that was very helpful, Joey. Thank you. With again an angel emoji. Really appreciate that one, Jennifer. Marina Rodriguez asked, can you review again what your investment yields and when a dividend is paid out? And so if you want to scroll down to the page, but Marina, we do have this capability on the platform. We show you the property status. And so typically speaking, when we list a property, it's after the inspection period, but before the closing period. And so being able to invest right up until the close date. And then when the close date happens, assuming we hit all the different contingencies in place and we pass through everything, then the asset starts to yield out to the end investors based on it. And it's paid out the following month for the previous month's operation. So if we close on it, for instance, in June 2025 here, anticipated first dividends will be July of 2025 for that June of 2025. Again, there might be a stub month in there where we close midway through a month. We can't time it perfectly, but we'll make sure to add that as a memo in the line item when you invest on the property. So each individual property, very different in terms of closing timelines, in terms of when they're looking to pay out their first dividends, but each property has this property status section where you can go in and check it out and plan accordingly. And so is there anything else there, Joe, that I'm missing?
No, spot on. Yeah, spot on.
Okay, thanks. Thank you. Thank you for the question. And if you do have any other questions, feel free to list them in the chat. Or if you have some stage fright and want to throw it in the questions, by all means, go ahead and shoot it in there.
I will say, I will add one piece. I think it's important that we be super transparent and also highlight the benefit of investing earlier before the anticipated first dividends, because most of these properties don't actually have a first debt service payment until typically 1 to 2 months after the closing date, which is tremendously valuable when it comes to the yield payouts, right? And so, when you're thinking about, 12% annualized yield, just as an example, I know you're getting, say, 1 to 2% up front. You're guaranteeing a huge part of that business plan, being that you've invested up front and you're getting those pro rata benefits right to the date that you've invested, especially for those, first few months of a property. And then that stabilizes, and then that income starts to grow right away, again, based off of that top line revenue growth. And then that kind of lower expense growth margin, so you can achieve that higher average yield through the entire whole of the property. So just wanted to highlight that.
And also, the earlier you invest, the earlier the calculation takes into account your pro rata ownership for that first dividend payout. And with that first dividend payout largely being a pretty massive yielding first dividend payout, you obviously get a little bit of a multiplier effect in that property. So by all means, the earlier you invest, the better it is. So we have another question from Ebony Gardner. What educational tools can you all suggest for someone who's new to investing in real estate? Also, how can I learn more about the platform? In parentheses, I was late to the call. No worries. We do send the call recording over in YouTube, and we're more than happy to provide any recordings of any of these webinars that we've given. And so if you go in there, you can see if you're a visual learner. I myself am not as much a visual learner. If you're a visual learner, we do have the YouTube channel that has everything there. And then at the beginning of the call, we did actually unveil a new help center. And in the help center, we give pretty comprehensive overview on how the platform works, the new features that we have there. It's docs.mogul.club is the URL, but at the bottom too, there's a link for help center that should be helpful there. All right, Thomas just threw it in there. Everything you need to know, the platform overview about Mogul, and we'll continue to add more and more educational materials in there. Outside of that too, we do have a kind of blog section, and we have a repository of our old newsletters that we've been sending out. And so you can go in there and check out. Joey had a pretty cool article that we sent along on, pretty cool, meaning cool for finance geeks like us, an IRR article about what is the internal rate of return, why is it important when measuring returns in real estate. So Thomas just dropped that in there, and you can check out any of our different Mogul Club posts. It's pretty comprehensive what we offer in there, but by all means, if you do have any other questions, we will continue to add. I will say the docs came about as an individual saying that they wanted even more information than what the Zendesk had offered, and this offers out some additional product features like asking in an AI chat what different things in the real estate and the platform offers. So that's one update we made directly from investor feedback, as well as the Discover page in the Mogul Club section is actually direct feedback from last week. A head of a Mogul Club said, I want to be able to see my club right away. So the Discover page has since changed. And actually the overview page, we added the breakdown of assets invested by total club. And so those are a few things that we continue to iterate on, especially if you give us feedback. We are more than happy to take it in stride. We know that the platform is not fully perfect yet, but our goal is to make it as close to perfect as possible and mold it to the best of our abilities. That way you all can invest as best as possible in the real estate. And we will never sacrifice the quality of real estate though for the platform. I will caveat that, because too many people immediately start just throwing bells and whistles, but then give up on the real estate. That's not at all what we're doing. We're doing it in parallel and in unison. So that's there. If there are any other questions, feel free to shoot them in the chat. If not, Joey, you want to dive into, unless we have anything more on the Taylor. If not, we can dive in to one of our sexiest assets to date, the Johnson out there. Oh, here it is. I knew we'd get this one. Landa is in the news for the wrong reason this week. Quote, fractional real estate. What can you share to current investors about approach that provide more security, confidence in the business model? So right off the bat, Joey, I can touch on the platform if you want to touch on the contingencies that we have within the real estate. So Landa is obviously very much in the public eye. And it's funny too, because a year ago, a VC said, why can't you be more like Landa? And we said, because we don't think their real estate is great, and they passed on us. So I hope to God their investment is recouped through Landa. Anyway, Landa is in the news because they defaulted on a number of their loans. They also had gotten in their earlier funding rounds loans, venture debt lent against the portfolio and collateralized by the assets themselves. And so while that happens and it's collateralized against the entire portfolio, that allows for a lender to seize on the entire portfolio, whereas our individual assets are collateralized at the individual PropCo LLC by LLC basis. So if for whatever reason an asset were to default, in the event of worst case scenario, which again, Joey can touch on in a second why that wouldn't be the case, because we have several contingencies in place. Each individual asset is still collateralized at the individual asset level. And as a result of that, it would only affect in a vacuum that one individual asset. It wouldn't go to the other assets on the platform itself. And so when you invest, you're investing in a wholly owned infrastructure and that financing of that individual asset. Outside of that too, in the event of a Landa just kind of went silent and basically are claiming that they own all the assets continuously through all this. In the event, for whatever reason, Mogul were to shut down, we have several contingencies in place to allow for operations and normal course of operations to continue. All of the ownership is recorded on blockchain. While you may not need to know what crypto is or how it works, we would basically just transfer everything on ownership to blockchain, and that records ownership in real time. And so think of it as a more efficient back office that we use to pass along a lower cost of barrier to enter, lower minimum, the $250 minimum. And so what would happen there is the individual, basically all of the correspondence would transfer to email, and dividends would be distributed directly to your bank account instead of to the individual in the platform. So basically that sexy UI UX that we work on so tirelessly, that would just go away and it would be replaced by your investing in real estate. And so you still own the asset outright. You still own the rental income and all the pro rata benefits, and the property manager would just interface with you over email. So that is one thing to continue. But Joey, if you want to touch on the reserves, as well as the insurance contingencies, as well as the several other creative measures that we have in the event of worst case scenario, if you want to dive into. Oh, and also real quick on that note too, a lot of times too, these platforms, these real estate platforms that had been started by non-real estate investors, they went out to market and they said, listen, we're going to source debt. And they would source basically bridge loans of 2 years at 10% plus interest rates, which obviously makes the leverage dilutive instead of accretive, which, I mean, Joey can dive more into that in depth in a little bit here, but it just, those loans are come due like this year from the 2 years ago, and they're paying out 10% interest rates when they were doing only long-term rentals on them. The proof was kind of in the pudding, or what's it when you like forecast this, foreshadow or whatever it is, Joey? I don't know.
Yeah, proof is in the pudding.
There we go. All right, yeah, I messed up. I quoted what was it? I quoted Goodwill Hunting. I went
Dead Poet Society, Goodwill Hunting earlier today.
Yeah, that was a mix up that I will.
That was a huge disappointment.
His eyes with that Robin Williams reference right there. But Joey, you want to touch on maintenance, vacancy reserve, and contingencies?
Yeah, I mean, I think I can answer James's question and Avery's in one. Just very high level quickly, as we've talked about before. Our buy box, or maybe just let me just caveat with saying, like, stock market investors and public equities investors, their job is to balance risk. I would say our job as professional real estate investors is to completely mitigate risk, right? Every single decision we make is, again, backed by data and making sure that there's contingency for every single thing that we do. And so I will say that on James's point, we have a buy box that we essentially construct around the lender quotes that we receive every single month. So we're tracking the cost of interest that Alex was just talking about, those interest rates really, really closely to make sure that all of the revenue that we do, whether it's through a short-term rental, through a long-term rental, through a midterm rental, can cover that interest at a healthy margin, justifying, what exactly that revenue is going to be, how that revenue is going to grow, structuring the debt to make sure that debt stays very, very much below that revenue. And then that way the yield is paid out to you as the investors, the appreciation is captured by you as the investors, as a kind of bonus on top of the property's value that's increasing, while that principal just stays the same, given that you're paying off that interest to the lender through the cash flow, realizing that return, and then, capturing that appreciation on your dollar invested. When it comes to the contingencies and kind of how we plan for the worst case scenarios, This was what we spent the entire really like first 2 years of this when we started back in kind of late 2021 thinking about how do we mitigate risk, how do we capitalize contingencies, how do we make it so it's the easiest, kind of low lift experience for all of our investors. And so thinking through the contingencies on the property, starting with the vacancy and maintenance reserves, right? One, we capitalize maintenance and vacancy reserves on each property to make sure that they're there to cover baseline expense loads and maintenance loads for the worst case scenarios in the property. So it's usually 3 to 5% of purchase price for each. Vacancy reserve is there to pay debt service and all the baseline expense load for about 9 to 12 months, assuming zero revenues for the property. That also gets replenished when there's an overage in income that's then replenished through the vacancy reserve and then distributed out to you as the investor as the yield and the cash on cash yield that you receive each month. And then on the maintenance side, that's there to cover anything that's not covered by insurance. So think, a toilet needs to be replaced, a cabinet needs to be replaced, and it's under $1,000. That's automatically going to go and replace that, and that's capitalized below the line, so your income isn't affected. The maintenance reserve goes out to paying that out, and then the maintenance reserve is replenished through that overage and income through the hold. As that, again, revenue continues to grow and your baseline equity exposure stays the same throughout the whole hold. Now on the insurance side of the equation, right? So that's there to protect you both on the dwelling side and as a landlord, as an investor in the property, as an owner. So on the dwelling side, we take out your typical dwelling insurance just like you would if you were to go and buy your own property. Typically, these, cover any kind of force majeure, acts of God, anything that's going to happen to the house that, isn't within your control and will be covered past a certain what's it called? The thing you pay out when you're paying out the minimum. What is it, Alex? Help me out. What is that? My brain's going. All right. Anyway, Alex isn't going to help me out. When you pay out that set level of required low thing that you pay out before the rest of the insurance pays for the rest, whatever. Anyways, and then the other one that we have is landlord insurance. So that comes in to actually cover you as the landlord and as the investor. And it's two things that are really important. One is liability insurance. So someone slips and falls on your property, a tenant sues you. The LLC, first of all, covers you as a personal investor, but then the LLC is protected by that liability insurance if it was taken to court. And then on the other side of it, it's actually loss of rent, right? Loss of rent, loss of use. And so assuming that the property can't be rented, that would kick in on the insurance side to effectively cover that loss of use, loss of rent during the time that the property is uninhabitable. So those are the two pieces of insurance, one again on the dwelling side, one on the landlord side. And those are just two of the major contingencies that we have on each property, on top of the structuring, on top of the DSCR requirements, on top of the diligence that we do, on top of the 3 contingencies in each purchase and sale agreement. All of these levers are there to protect you as the investor, to make sure that, again, it's as mitigated as possible, because our job as real estate investors is to mitigate risk. So.
And apologies, Joey. My brain is also lapsing right now pretty hard. I mean,
all right, I thought you were just giving me a hard time.
No. I to be honest with you, I spaced out for a second, and then I looked behind me and I realized I still had a Kanye poster on my wall. So that really set me down a spiral of, anyway, don't review my facial expressions when thinking through. Anyway, all right. So one of the questions we got is, which blockchain do you use? So we are fortunate to partner up with the Ava Labs team, so Avalanche blockchain. They have become a real push into the DeFi meets real world asset play, and has really started to work with some major financial institutions behind the scenes. Think your JP Morgans of the world, to bring real world assets to blockchain and on chain, so to speak. And so that's the blockchain that we use. The next question and let me know if there are any other questions related to the blockchain component. I do think there's one more. So can the SEC force these investments to be reclassified as a REIT? So the way that we're structured is as an investment club, and so passing along the direct benefits of the real estate to the end investor, similar to how if you, me, and Joey were to go out and invest in a property, it would be structured as an investment club. Really came about because the SEC said, we don't really want to have to manage all these small mom and pop investors coming together and investing on tennis courts and golf courses. And so they came up with the investment club structure, where if you have governance rights over the individual assets and the operations of the assets, and again, not the day-to-day mind-numbing $50 fix to a fan or a lock might be broken or something like that. That's handled by the property manager, similar to how we all were invested in the properties. The property manager would handle it directly and just deduct it from rent. And it goes directly into that capitalization and that $1,000 capex. Above the 1,000 capex, it gets put to a vote on different directions that you can choose based on property management recommendations. As to if it could ever be reclassified as a REIT, to be honest with you, we would not ever reclassify as a REIT. The other thing that we could do is reclassify as a Reg A or Reg D. The REIT, in my opinion, is the greatest marketing scam to allow for everyone to invest in real estate without getting any of the direct benefits of the real estate. And so investing in a REIT, it would never be reclassified as a REIT per se. And so that's that question.
Deductible, by the way, deductible. Goodness. Deductible was my big brain fart moment.
You're still thinking. I passed by.
Got it.
And then, yes, I want my K1, Daniel. Thank you. Yes, we actually did work on that. All the K1s are out except for the Logan. Currently, the Logan, we're working on some minor tweaks there, minor fixes there, so we should have them out momentarily. Again, apologies for it. There was a personnel change that we're making right after we're done fully with the tax documents here. So we do appreciate the patience there. We've been working through it, but again, all passive losses across the board. And as a result of it being a passive loss, it actually doesn't impact the end investor unless you are invested in private equity funds outside of it and have passive income from other private equity funds and private equity vehicles. And so worst case scenario is you can carry it forward for 3 years and it really doesn't impact your filings at all. And so we're passing along those K1s. You should see them all except for the Logan, which again, we're working through. And so another one, I am new here. Sorry if this is well known, but I didn't realize these property investments were on blockchain. So you hold the wallet and all our tokenized NFTs in our wallet, or are they in our own custody wallet? Back to the topic of what happens if Mogul is away, do we control our own wallets? So all of it is done in wallets. And so we work with custodial providers of wallet infrastructure. And so you do have a wallet with us and it's your own individual wallet that is, again, there are several security measures in place to manage your to manage your private keys related to that individual wallet. And so each individual share is, again, an NFT. It's an ERC1155 token. So it is an NFT-like structure that represents ownership in the individual property. If you go to the operating agreement of any individual asset and go to page 42, which is the last page of the operating agreement, you'll be able to see directly what that ownership looks like as it relates to the individual property tokens. Now, Joseph asked, are there any plans to include ongoing reserve balances for each property on the portfolio tab? Yes, we actually have been discussing that. To be honest with you, our goal would be to do it when we can actually tokenize the reserve balance and bring it completely on chain. That way it's complete transparency, right? Because if we put out the individual reserves on the individual property by property page, it's not as transparent as offering it through blockchain. And so the idea would be, obviously, as stable coins become more prevalent, the goal would be to have all of our ongoing reserve in stable coins that have been minted by the US Treasury. And the idea being that you could have a fail safe for these are the exact ongoing reserve balances for each individual property. Now, we are discussing potential solutions in the meantime, and that is on our product roadmap to offer even more transparency into the individual properties. But again, that is a little bit ways off for the individual reserves. Again, let me know if you have any questions on that front. But we do want to create as transparent an investing process as possible. So we are discussing that in the background. Nathan, another question from a new guy. What happens if a property on the platform isn't fully invested in by the closing date? Does the project still move forward with the folks that did invest? Yes. Property still moves forward, even if a property doesn't. So for instance, this property has a longer raise timeline, but we only need about 660K to 700K to close on the property. So there's about 370K remaining in the, no, 270K. Jesus, it's been a long day. So 270K remaining in this individual asset. So people are continuing to invest in this property itself. I mean, it's gone up over 150K in the last week or so. And so we will plan on closing on it regardless of if funds come in the door. We do have a pretty extensive balance sheet, but outside of that too, we're working on getting a line of credit to expedite the amount of properties that we can bring to the platform itself. But we will continue to move forward by the closing date because our thought process there, the asset itself is such a healthy yielding asset that we diligence. We're more than happy to take it as some sort of balance sheet exposure if need be on the asset, especially with some of these properties. Dan, great. Thank you for the blockchain NFT info. Great. Avalanche is a great partner. Happy to hear that. Yep, completely agree. They've been tremendous with us. Daniel Cathay, do you invest with us? I'm invested in every single property. Joey and I are typically the first checks into each individual property. So I don't think you can get higher conviction and incentive alignment than an individual investing in each individual property. I mean, Joey, I don't know if you have anything else to speak on that.
Yeah, 100%. I mean, yeah, not try to say that we throw in, 4-figure checks individually to every single property. We offer out the property to our entire team internally because we have so much conviction around the investments that we're launching on the Mogul platform, sponsoring on the Mogul platform. And so, that we're obviously just as invested as you guys are, and your success is our success. So, on Corey's question really quick, do you investors get paid monthly? Yes. We do have monthly dividends, and before time is up, actually, Alex, maybe we should also talk about the transition going forward as we scale up on the appreciation and dividend dates.
Yep. Yeah. So I'm happy to go through unless you want to, Joey.
Go for it.
Yeah. So as we've been discussing with our property manager, we have always said that it's the second Tuesday of every month that we distribute dividends for the previous month's operations of the asset. Now, when we've been pushing that, it has definitely been putting some strain on the individual property managers. And we definitely think that it would be more helpful to the property managers and make more sense if we extend out the timeline for the payment of the dividends by about a week, right, Joey? What was the final date that they discussed?
Yeah, that's right. So it'll be the third week of every month.
So the third week of every month, it gives us time. We've been talking with our property managers, and they said that typically speaking, they send out, especially with short-term rental and mid-term rental, because there are so many things happening and last-minute stays that are getting booked, that the accounting that we've been asking for is actually completely unreasonable to expect that on the go forward, and especially as we continue to scale out. Now, this won't impact the amount of dividend. It will only impact it by a week for paying out a week later. And again, we've been told that anything earlier than the 15th of any month, it was crazy that we were expecting that on the go forward. But again, that is just something that we have to work with. You are still getting monthly dividends that we're paying out on the third week of every month now. So it'll be pushed back by 1 week. But again, does not impact the amount you're getting investment from the dividends, but it's just impacting the timing of the payout of the dividends. So that is just one thing that we do want to caveat. But I will say, Mogul clubs, if you're looking for any sort of yield or any sort of incentive reward payouts, even prior to that dividend payout, we obviously offer a tremendous amount of rewards through those different clubs that are automatically added to your balance. Do you plan to bring properties outside the U.S. anytime soon? Canada, Mexico? I mean, Joe, not yet.
We facilitate obviously investment into U.S. properties right now, just because one, we have the infrastructure, the structuring, the transparency, and the benefits of having infrastructure and boots on the ground to be able to service every single property. Again, knowing the insights into every market, knowing who the best inspectors are, who the best kind of appraisals are, like who the best infrastructure partners are, to make sure that, again, we're mitigating risk from every single aspect possible. Now, that's not to say we might not expand our offerings abroad at some point naturally across North America, which seems to be where the question was going. And so, I will say that it's definitely not impossible for the future, but for now we're focused on U.S. real estate, where we drive the most efficiencies, the most competitive advantages.
Definitely. And one of the other questions that popped up is, any plans to lower the minimum from $250 to say $100 on the properties? To be honest with you, we did start out with $100 on the properties in the minimum early in our earliest of days. However, as we've been looking at the trends, its average investment size is roughly $8,800. So people are coming in and investing multiples of the minimum. And to be honest with you, we definitely have tried to keep the most efficient back office possible, and that allows for that $250 minimum. However, the $100 right now is not on the product roadmap. Our goal is to continue at the $250 minimum. And we have seen that a lot of people when presented with the $250 minimum, it really doesn't faze them because they're planning on investing multiples. And you should treat each individual investment in the properties almost like an interest-bearing savings account. And so pledging assets to an interest-bearing savings account that is going to continue to yield out. It's kind of a set it and forget it type model where you put it away in a property, you get yield paying out from it, and then obviously it pays out with the appreciation one day. But that's just to answer. Our goal is to stay at the $250 minimum for the near future. And so that is our time. If you do have any other last questions, by all means, feel free to shoot them in the chat. Feel free to shoot them over email. Our goal is to make as many iterations to make this the best possible platform as possible. I really like many of the features on your platform, especially the bull bear base case calculator tool. I'm so sorry to hear about losing your books. I'm very sorry too. As an author, publisher, book maven, I can't imagine. Life Guidance Books is an online bookstore I run that offers a lot of the best business, personal growth, and development books if you're seeking to replace some of your books. I do appreciate that, Jennifer. We do try and stay away from we do try and stay away from obviously like soliciting in the chat. So do appreciate the questions and do appreciate, but I would appreciate, let's keep it to at least in the realm of real estate and the Mogul platform. That way people can obviously learn and continue to learn alongside one another. But again, thank you everyone for joining today. And by all means, let us know if there's anything we can continue to improve on. Joey, anything
Awesome.
left?
No, yeah, appreciate everyone. Thanks so much.
Perfect. Exactly. We may all have something to say. Exactly. Yeah, that's exactly right. So we're trying to keep it as mogul centric as possible, and let's avoid this coming from the guy that actually got yelled at by his apartment building for soliciting from tenants. But anyway, thanks so much everyone for joining, and do appreciate and stay tuned for next time.
Thanks everyone.
Thank you.